of price rises on the value of national output is removed. Sustainable economic growth means a rate of growth which can be maintained without creating other significant economic problems, especially for future generations. There is clearly a trade off between rapid economic growth today and growth in the future. Rapid growth today may exhaust resources and create environment problems for future generations. Over to you, Priyansha.
Today's session will be a case-driven session in which students will be delivering the presentation on various crises like financial crisis 2008, Greece debt crisis, Asian currency crisis, Venezuela debt crisis, Zimbabwe crisis, and the Indian economic crisis 1991. To take us forward, I would like to introduce Dr. Lakwinder Kaur Dhillon, who would be taking the session today. She is a specialized faculty of corporate finance, strategic financial management, accounting for managers, and international finance for risk management. Working with Amity Business School, flagship institute of Amity University, Uttar Pradesh, for 12 plus years. Dr. Dhillon is PhD, MPhil, and MBA in finance. She has also successfully completed certificate course on strategic management from IIT Delhi and summer school in empirical finance and accounting research from IIM Kolkata. In her illustrious continuous career of 17 plus years, she has achieved many milestones in teaching of various subjects of varied dimensions of accounting and finance. She has attended and organized number of workshops and FDPs along with her teaching assignments. She has also imparted training to the employees of Tata Motors, Axis Bank, PBORS, and Armed Force officers of DGR on analysis of financial statement. Now, I would request ma'am, please take over.
Thank you, Priyanshi and Divya. So we already had discussion that what is expected from the groups that is being assigned the presentation. So I'll do the sum up at the later part of the session. I request the first group to come up with the first case, that is Greece debt crisis. So who is taking care of Greece debt crisis? Okay.
Yes, ma'am. Thank you, ma'am.
Yeah, please.
Wait a second.
Yeah, please.
Thank you so much, ma'am. And greeting to all. And I'm Yuvraj. I'll be talking about the Greece debt crisis. Next slide. So first we'll talk about the debt crisis. Various forms of governments finances their expenditure primarily by raising money through taxation. When tax revenues are insufficient, the government can make up the difference by issuing debt. A debt crisis can also refer to a general term for a proliferation of massive public debt relative to tax revenues, especially in reference in Latin American countries during 1980s, the United States and the European Union since the mid 2000s, and the Chinese debt crisis 2015. Next slide. So Greece debt crisis. The Greece debt crisis is the dangerous amount of sovereign debt Greece owned the European Union between 2008 and 2018. In 2010, Greece said it might default on its debt, threatening the viability of the Eurozone itself. The crisis triggered the Eurozone debt crisis, creating fears that it would spread into a global financial crisis. It warned of the fate of the other heavily indebted EU members. The massive crisis was triggered by the country whose economic output is no bigger than the US state of Connecticut. Next slide. So here are some causes of the debt crisis. First is European member states show high deficits, which is these developed into a debt and could turn into a state bankruptcy. This is also applied to a Greece. Compared to Germany, Greece had current account deficits amounting to 14.5% of GDP. On the other hand, Germany with a surplus of 7.5% of the GDP. Some high exporting countries in the Eurozone and had more savings than investments. Second is huge reduction in the competitiveness of the Greek economy. It is one of the main cause of the crisis. Here, labor costs have risen significantly faster than the productivity. In 2011, pension increases represented 11% of the Greece GDP, the highest in the Eurozone. The privatization of the enterprises and thus also the private economic activity was strongly impeded by the public administration. Third cause is the change of currency. The change of currency, the Greek state soon had to realize that the seemingly positive consequences quickly developed as negative ones. These supposedly positively effects include easier accessibility to the capital and the reform of the Greek, the banking and sector. So the fourth is the adoption of the single currency. Led in that direct contrast to the supposedly positive consequences to negative effects, the change that automatically made the member states lose control of their own currency. Thus, the associated risk of insolvency followed, in contrast to highly indebted countries with their own currency, such as Japan, the US, or the England. And the fifth is the insufficient risk of assessment of the Greek debt. The over-indebtedness of a country should be prevented from the market in the advance. The market are in the change of controlling and they have the power to do so. Next slide. So here's the video how Euro caused Greek economy.
To understand what's happening with Greece and the Eurozone, think about a dinner party. If you're cooking just for yourself and your spouse, it's easy. You make something you both like. But if you've got guests, things get harder. If you need to accommodate a vegetarian and someone who's gluten-free and someone with a soy allergy, your options get really limited. And that's the problem with Europe's idea of having a whole bunch of countries all use the same currency. So Greece's economy is in a disaster. A quarter of the population is unemployed, and it has this very high debt burden. Normally, if you've got really high unemployment, what happens is that a country makes its currency cheaper by printing extra money. That makes its products cheaper on world markets, it makes it a more attractive tourist destination, and it means that foreign investors can get great bargains. But if unemployment's really low, a country likes to have an expensive currency. That increases people's purchasing power and it keeps prices down. And in Europe, you have a bunch of economies that are really different. A price of euros that's appropriate for Greece, where they have a 25% unemployment rate, is way too low for Germany, where the unemployment rate's below 5%. And Greece's problem is that it's small, poor, and geographically isolated from the rest of the Eurozone. It's like the only vegetarian at the barbecue, except when it comes to currencies, there's no side dishes. And so there's plenty of specific decisions we can second guess, plenty of things Greece did and various banks did that we can question. But fundamentally, having all these countries come to a dinner party with only one dish on the menu was a mistake. The euro was a project that Europe set about on for really political reasons. It was a symbol of their determination to have peace on the continent. But they didn't really take the economics of it seriously. So Greece joins the euro in 2001, and initially it works out great for Greece because all of a sudden everyone was like, yeah, sure, let's lend the money. So they borrowed lots and lots and lots of euros, except that didn't change the fact that their economy is a lot weaker than some of the other European countries. So to really work, you would need a much, much, much closer union where you had big financial transfers coming from the richer places to the poorer places all the time. In the United States, the poor states like Kentucky, Mississippi, Alabama, they're constantly getting money from the richer states like Massachusetts, California, New York through the welfare system, through Social Security, through Medicare, through Medicaid. And, people may sort of complain about this or that program, but we don't dispute the idea that it's all one country. So money is going to circulate around. Europeans, they just don't feel that way. Germans are willing to support poor German people, but they don't want to support Greek people with their tax dollars. So they're kind of like halfway integrated in a way that doesn't really work.
Next slide, please. So here are some of the outlooks. So despite austerity measures, many aspects of Greece economy are still problematic. Government spending make up 48% of the GDP, while EU bailouts contribute around 3%. As of 2017, Greece relies on tourism for 20%. GDP bureaucracy often delays commercial investments for decades. The government has shrunk but still inefficient. There is too much political patronage. The government decision making is centralized for the slowing response. So this bureaucracy combined with unclear property rights and judicial obstacles has kept Greece from selling 50 billion euros worth of state-owned assets. Only 6% billion euros worth of property has been sold in since 2011. Many of the jobs available are part-time, pay less than before the crisis. As a result, hundreds of thousands of the best and the brightest have left the country. Banks haven't completely corrupted and are hesitant to make new loans to businesses. It will also slow road to a recovery. Thank you.
Yeah, thank you, Yuvraj. That was a nice presentation. I just want to ask you a few questions. You must have read about it so nicely. So, like, if I'll ask you a question that who was the biggest lender to Greece? You remember when you were reading who was the biggest lender to Greece?
Am I audible?
Yes.
Yes, ma'am. So the biggest lender was the NBG, National Bank of Greece,
Okay.
Euro Bank, and the Alpha Bank.
Okay. So you wrote in your last slide about austerity measures. So what are these measures actually?
Sorry, ma'am.
You wrote, just go back to your last slide. You wrote despite austerity measures, many aspects of Greece economy are still problematic. So what are these measures? Do you remember any measures, like which measures are called as austerity measures?
Ma'am, I don't have really remembered that much of. I didn't go into that deep.
Okay, no big deal. I'll tell you. It's basically the measures that results in reduction of government spending and increase in taxation and or doing both the thing. Tax, that is, government is increasing tax at one place and government is reducing their spending. So these are very harsh measures. So these are basically known as austerity measures. Thank you so much, Yuvraj, for the presentation. Can I
Thank
have the next group, please?
Good afternoon, ma'am. Am I audible and visible?
Yes, you're audible and visible both. Thank you.
Okay.
Yeah. Okay.
So, good afternoon, everyone.
Asian financial crisis. Okay, take care. Yeah, continue.
Good afternoon, everyone, and good morning to my friends from UK. Today, I, Vanshika, am going to take a small presentation on the Asian financial crisis. A financial crisis is generally defined as any situation where significant financial assets, such as stock or real estate, suddenly experience a sharp decline in value. They are often preceded by periods of economic boom and overextension of credit to borrowers. The Asian financial crisis was a period of crisis that gripped much of East Asia beginning in July 1997 and raised fears of a worldwide economic meltdown due to financial contagion. Next slide, please. Okay. The crisis started in the beginning of July 1997 in Thailand. Started in Thailand with the financial collapse of Thai baht. The Thai government was forced to float the baht due to the lack of foreign currency to support its currency peg to the US dollar. As at that time, Thailand had acquired a burden of foreign debt that made the country effectively bankrupt even before the collapse of its currency. As the crisis spread, most of the Southeast Asia and Japan saw slumping currencies, devalued stock markets and other asset prices, and a precipitous rise in private debt. Indonesia, South Korea, and Thailand were the countries that were most affected by the crisis. Next slide, please.
Now we learn about the causes of the crisis. During the late 1980s, next slide please. Yeah. During the late 1980s and the early 1990s, many Southeast Asian countries, including Thailand, Singapore, Malaysia, Indonesia, and South Korea, achieved massive economic growth of an 8% to 12% increase in their GDP, that is, gross domestic product. The achievement was known as the Asian economic miracle. However, a significant risk was embedded in the achievement. The economic developments in these countries were mainly boosted by export growth and foreign investments. Therefore, high interest rates and fixed currency exchange rates were implemented to attract hot money. Also, the exchange rate was pegged at a rate favorable to the exporters. However, both the capital market and corporates were left exposed to foreign exchange risk due to the fixed currency exchange rate policy. Next slide, please. The second cause was the tripping point. In the mid-1990s, following the recovery of US from a recession, the Federal Reserve raised the interest rate against inflation. The higher interest rates attracted hot money to flow into the US market, leading to an appreciation to the US dollars. For Asian countries pegged to the US dollar, the higher US dollar caused their own export to become more expensive and less competitive in the global market. And at the same time, US Asian export grew. With a shock in both export and forest investments, asset prices, which were leveraged by large amounts of credits, began to collapse. The panicked foreign investors began to withdraw. The massive capital outflow caused a depreciation pressure on the currencies of the Asian countries. The Thai government first ran out of foreign currency to support its exchange rate, forcing it to float the baht. The value of the baht thus collapsed immediately afterwards. The same also happened to the rest of the Asian countries soon after. Next slide, please. Anything that occurs leaves an effect. So the impact that this crisis had were as follows. The countries that were most severely affected by the Asian financial crisis included Indonesia, Thailand, Malaysia, South Korea, and the Philippines. They saw currency exchange rates, stock markets, and the prices of other assets all plunge. The GDPs of the affected countries even fell by double digits. From 1996 to 1997, the nominal GDP per capita dropped by 43.2% in Indonesia, 21.2% in Thailand, 19% in Malaysia, 18.5% in South Korea, and 12.5% in Philippines. Hong Kong, mainland China, Singapore, and Japan were also affected, but less significantly. Besides its economic impacts, the Asian financial crisis also resulted in political repercussions. The Prime Minister of Thailand and President of Indonesia resigned. The impact of the Asian financial crisis was not only limited to Asia. International investors became less willing to invest in and lend to developing countries, not only Asia, in other areas of the world. Oil prices also fell due to the crisis. As a result, some major mergers and acquisitions in the oil industry took place to achieve economies of scale. Next slide, please. This Asian financial crisis taught many lessons, not only to the affected countries, but to the entire world. Next slide. One lesson that many countries learned from the financial crisis was to build up their foreign exchange reserves to hedge against external shocks. Many Asian countries weakened their currencies and adjusted economic structures to create a current account surplus. The surplus can boost their foreign exchange reserves. The Asian financial crisis also raised concerns about the role that a government should play in the market. Supporters of neoliberalism promote free market capitalism. They considered the crisis as a result of government intervention and crony capitalism. The IMF generated several bailout packages for the most affected countries during the financial crisis. It provides packages of around $20 billion to Thailand, $40 billion to Indonesia, and $59 billion to South Korea to support them so that they did not default. The conditions that IMF set within their structural adjustment packages also aimed to weaken the relationship the government had with the capital market and in the affected countries, thus to promote neoliberal model. Next slide, please. So the major lessons that we learned for the future's sustainability were as follows. Hold less debt in foreign currencies, allow exchange rates to be more flexible, build up foreign exchange reserves, don't run large current account deficits, and last but not the least, to improve banking oversight and coordinate policy with other countries. Thank you and namaste. Thank you, ma'am.
Yeah, Vanshika, thank you so much. It was a very nice presentation, and I just want to add it here that because the flexible exchange rate system started in 73, and after that, major reforms were there where many countries went for a flexible exchange rate system, and when there was it was hot money that was flowing to this destination. Can you remember, can you tell me name of few currency that were involved? You use the name of the countries, not the currencies. Can you give me the names of the currencies? Yes, any three currency that were involved.
Ma'am, I have no idea about it.
Okay, Thai baht you said. For Philippines, which currency they have?
Ma'am, I think Thai baht is for Thailand only, right?
Yes,
So,
yes.
ma'am, I have no idea about the currencies of different countries.
Okay. It is peso was there for Philippines. Okay, so it was peso, and for Indonesia it was rupiah. So it was there, and for Hong Kong it was Hong Kong dollar. We used to have that. So it was basically a sudden stop that had happened because of the US. Every money started moving back to US, and the destination become less attractive, and everything had happened. So this is something, a lesson which is learned, that if your GDP is very high, and if different economies are perceiving you as a very highly growing economy, and a lot of hot money is coming to your destination, you should be very firm in decisions for your economic activities and for developmental activities. So you should not rely on hot money. Instead, you should take care of international flow in the form of FDIs, basically, if you want to make your destination very attractive. So thank you so much, Vanshika. Can I have the next presentation, please? Indian economic crisis. Okay, 1991. So this is a very interesting, and challenging also, because this is something that has changed India a lot. 1991 crisis. Yes, please go ahead.
Just a second, ma'am.
Yeah.
Good morning, UK. Good afternoon, India. Today I am going to talk about Indian economic crisis 1991. The Indian economic crisis was an economic crisis in India that resulted from poor economic policies and resulting trade deficits. India's economic problems started worsening in 1985 as the imports swelled, leaving the country in a twin deficit. The Indian trade balance was in deficit at a time when the government was running on a huge fiscal deficit as well. The crisis in turn paved the way for liberalization of the Indian economy, since one of the conditions stipulated the World Bank loan required India to open itself to the participation from foreign entities in its industries, including its own state-owned enterprises as well. Indian economic crisis causes poor economic policies. The crisis was caused by the currency overvaluation The current account deficit and the investor confidence played significant role, and the sharp exchange rate depreciation in the Indian economic crisis. The crisis was primarily due to large and growing financial imbalances over 1980s. During mid-80s, India started having the balance of payment problems between the Gulf War and the import bill swelled. Large fiscal deficits spilled over the effect of the trade deficits and the external payment crisis as well. The gross fiscal deficit of the government, center and state, rose from 9% of the GDP in 1980 to 1981. India was not in a very good state at that time. India's exchange rate was subjected to severe adjustment. The event began with a slide in the value of Indian rupee, leading to mid-1991. The authorities of the Reserve Bank of India took partial action defending the currency by expanding international reserves and slowing the decline of the value. Next slide, please. The recovery from the Indian economic crisis. The government have been spending more than its revenues and the country importing more than exporting, which was not a very good sign for the country. The Chandrasekhar government had collapsed in a few months after authorized the airlift. The move held tide over the balance of the payment crisis, and the kick started P.V. Narasimha Rao's role in the economic reform process. Government of India immediate response to a secure loan of 2.2 million from International Monetary Fund by pledging 67 tons of India's gold reserves as collateral security. The Reserve Bank of India had to airlift 47 tons of gold to the Bank of England and 20 tons of gold to the Union Bank of Switzerland to raise 600 million. The van transporting the gold to the airport broke down en route due to tire burst, and the panic followed. The airlift was done as the secrecy, and it was done at the midst of 1991 crisis, which was not a good sign in the recovery as well. Next slide, please. Thank you so much.
Hi, Gayatri. Thank you. Gayatri, I just want to ask you, can you give another name to this crisis? This crisis was specifically related to one particular aspect of our economy. What was that? Can you name that?
Ma'am, I believe it was related to the twin deficit, the Indian trade balance, and
so that's all is related to what? What is that main account name?
Balance huge fiscal deficit.
It is balance of payment. So the last crisis that was discussed was on currency crisis. Before that it was debt crisis. The crisis which you discussed, it was more like to balance of payment. That is how the country was not able to finance its deficit, how imports were increasing, and how the currency was depreciating, and how the situation was not under control, and finally they have to open up the economy. So when they opened up the economy, what policy they opted? Do you name that policy?
Ma'am, the policy I believe they opted for was the exchange rate policy in order to stabilize the Indian economy.
Yeah, it is LPG policy, that is liberalization, privatization, and globalization. And you spoke about airlift. Do you remember what happened at that point of time? What was that event because of which that airlift had happened in the
ma'am, the event
Chandrasekhar's government was out of the process.
Yes, ma'am, that actually the Reserve Bank had airlifted 47 tons of gold to the Bank of England and then 20 tons of gold to the Bank of Switzerland. While transporting the gold, there was a tire burst, and which was done on intentional basis, and it was done in the midst of Indian general elections, 1991. So the national sentiments of the people outraged, and there was a public advocacy, and then the government pledged that the entire gold reserves will be used against the loan, entire country's gold reserves. So a chartered plane was hired, and the precious cargo was sent to London on 21 May. So this is how the Chandrasekhar government collapsed in a few months after this airlift.
Yeah. Okay. Thank you so much, Gayatri. Thank you very much. Can I request the next presentation? Okay. This is Venezuela crisis. Yes, please continue.
Yeah, thank you, Gayatri, for the presentation and greeting all. I will be myself Shem Tagi. I will be explaining Venezuela debt crisis. Venezuela has been in the news on and off for the past couple of years since from country has shown pictures of long lines of grocery stores, food riots and young teenagers protesting in streets with National Guard using tear gas against them. Last year, for more than 3 months, thousands of Venezuelans protested daily against government of Nicolas Maduro. Many of them were young students. Over 120 people were killed during these protests at hands of government forces. More than 5,000 people were arrested, and stories of abuse and torture were common. Venezuela, the country with the largest proven oil reserve in the world, is in suffering of humanitarian crisis, bordering Colombia and Brazil in South America. The mountainous country with the white sand, beaches, and highest waterfall in the world has been engulfed in the political, economic, and social struggle for most of 21st century. Next slide, please. For the reason as Venezuela has collapsed, the economy has collapsed and uprising of political opposition of President Nicolas Maduro has put the country leadership in question. About 5 million Venezuelans have left the country seeking food, work and a better life. An estimated 1.8 million people have settled in Colombia, 8,61,000 in Peru, 4,56,000 in Chile, 3,66,000 in Ecuador, and 2,53,000 in Brazil. Close to 4 lakh Venezuelans are in United States and about 3 lakh in Spain, according to the UN International Organization of Migration. Next slide, please. So basically, I will be explaining Venezuelan crisis timeline at how it started from 1920s to current year 2020. 1920 to 1917, oil is discovered in Venezuela, which is found and have been world largest reserve. The national economic development is based on rising pricing and profit oil exports. From 1980s to 1990s, global oil prices fall, Venezuelan economy contracts, the country faces massive debt. Now, 2000, Chavez expanded social service, but corruption was rampant, and steady decline in oil production reduces oil reserve and increased government debt. From 2013 to 2014, after 14 years of Chavez rules, Chavez dies of cancer at age of 58. Chosen successor Vice President Nicolas Maduro takes the power, assumes the presidency, and Nehru wins the election. With the inflation more than 50% in a year, the National Assembly gives Maduro emergency power for a year beginning November. Public standards were critical bill because low prices and anti-government protests are broken with force. Next slide, please. From 2015 to 2018, opposition Democratic Party wins control over National Assembly, ending 16 years of social party rule. The economy is in crisis and healthcare system lacks funding, hunger, malnutrition, maternal and child mortality, infectious disease and unemployment increase alarmingly. From 2019 to 2020, Mondon Son in his second six-year term, an opposition leader and head of the National Assembly, Guan Guizhou, declares himself to be interim president according to the constitution. He is recognized as such by US, Canada, and Venezuela's Latin American neighbors. And in the recent 2020, as coronavirus pandemic spreads in Latin America and border closing and the collapse of global oil prices have made life even harder for Venezuelans. Next slide, please. Why is Venezuela in crisis? The reason for Venezuela is in crisis are years of hyperinflation, violence, food, and medicine shortage. The country was once considered the richest in Latin America thanks to having largest oil reserve in the world. But more than decade of declining oil revenue and poor governance led to collapse of the national economy and government has not been able to provide adequate social services. Most of Venezuela are fleeing to neighboring countries. Of 5 million people who left Venezuela, at least 4.2 have remained in Latin America and in Caribbean. The highest concentration of Venezuelan migrants is in Colombia, where more than 1.8 million of them have relocated. How many people have affected by the crisis? Estimated suggest that between 4 and 18 million of Venezuelans from every walk of life have left their homes since 2014. About million of Venezuelans have left the country to find work, food, better healthcare and stability. Thank you.
Thank you, Shivam. You just tried to explain it. You tried to justify the issues of this country. Um, can you tell me that what petrostate means? Petrostate. This Venezuela is referred to
Ma'am,
as petrostate. Can you tell me
yes,
what
ma'am.
is what
Ma'am,
petrostates mean?
Ma'am, petrostate means the country totally depending on the oil revenue generation and their estimated GDP and all economic revenue is overall depend on oil revenue from their own resources.
Okay. Beside this, there are other attributes that are associated with a petrostate. One you said very good, that is government income is deeply reliant on the export of oil and natural gas. Then the economic and the political power are highly concentrated in elite minorities. Okay, and at the same point of time the political institutions are weak and there is very less accountability and widespread corruptions is there. Can you think about any other country who all are referred as petrodollar petrostate?
Um,
Any other country?
Algeria and
Yeah.
Libya. Yes.
Yes. Good. Thank you so much. Thank you, Shivam. Can we
Thank
have
you.
the next presentation, please? Okay, very good.
So thank you, Shivam. That was a really nice presentation. So greetings to all. My name is Manikjot, and today I will speak on the topic Zimbabwe's crisis. Can we have the next slide, please? So the topics which we'll discuss today is introduction of the country, economic crisis that happened, intensity of that crisis, and daily life of people that affected it. Next slide. Okay, so we'll start off with the introduction. So, Zimbabwe, officially also known as Republic of Zimbabwe, is a landlocked country located in southern Africa between the Zambezi and Limpopo rivers. The capital and the largest city here is Harare. So, Zimbabwe got independence in 1980 from the British colonial rule under the leadership of Mr. Robert Mugabe, which we will discuss further as he plays the main role in the economic crisis, who became the president in the newly formed government and later became the president in promoting socialism and partially relying on the international aid such as World Bank and IMF. So third is the balanced economy transforming from being a primary producer into a big name with strong manufacturing sectors and mining ventures. Next slide, please. So now we'll discuss about the economic crisis that happened in the country. So Zimbabwean government launched an economic reform program essential in liberalizing the economy and dealing with structural impediments to growth. The country suffered with two serious droughts that were in 1992 and 1995, affecting the agricultural productivity. In 1997, government announced new compensation and pension plans for war veterans, which resulted in approximately taking up the 3% of the 1997 GDP of the country at that time, which was also not included in the budget of the fiscal year. Also, the payment had the immediate effect on inflating the budget by 55% as comparative to the previous year. So the World Bank suspended the funding to the country until the government had demonstrated the payments made, how the payments were made, and where the payments are being put on into. So Mugabe responded to these pressures, announcing plans for the compulsory acquisition of the white-owned commercial farms, again without elaborating the financial side. So they were basically acquiring the white-owned farms that were there with the white people, and without any compulsory notice, they were just acquiring it. Next slide, please. What were the effects of the decisions or the policies that were made during that economic time? So investors panicked about the future fiscal position of the Zimbabwean government, as therefore resulting in flight of foreign capital, which caused crashes in the Zimbabwean money and capital markets and exhausted the foreign reserves of the country. Also, it led to scaling back of the assistance from World Bank and IMF, so suspending their aid. This whole scenario further led to hyperinflation. Next slide, please. So, what was the intensity of that hyperinflation? I have made a picture explaining it. In 1983, when US dollar one was Zimbabwean dollar one. In 2000, one US dollar became 1,000 Zimbabwean dollar. In 2006, one US dollar became 100,000 Zimbabwean dollar in Jan 2006. And in the mere period of 6 months, that is in July 2006, 500,000 Zimbabwean dollars was equal to only one US dollars. And also, I would like to add here that at the current time, one USD is equal to 361 Zimbabwean dollar, and at the time of 2008 economic crisis, 50 million Zimbabwean dollar was equal to one USD at the time. So it was that great of inflation. Can we have the next slide, please? Yeah. So I'll discuss more about the intensity in different sectors. In agriculture sector, tobacco and wheat production decreased by 1/6 during the period of 5 years. That was from 2008, 2003, 2008. And in healthcare sector, there were shortages of anesthetic, antibiotics, gloves, water, electricity, and which made it totally impossible for healthcare sector to function. In education sector, there was lack of funding, there was no experienced personnel teachers, and there was also lack of equipment. Can we have next slide, please? So what was the effect on the daily life of the people? So there were severe shortages of fuel, electricity, and other essential items during the time of hyperinflation. Real interest rates remained sharply negative. Earning more money, people got engaged in black market. People tend to use barter system more than buying with cash. It was difficult for firm or business to sell goods. Therefore, people had to engage in illegal activities also. So at that time, there was a huge inflation which led people to do these kinds of things. Can we have the next slide, please? Thank you so much. Thank you so much for listening.
Yes, Manikjo. Thank you for this presentation. I just want to ask you one thing. What is like if you are given an option to take some remedial measures, okay, so what measures you can take to improve the situation of a country who is facing hyperinflation?
Okay, ma'am. So, ma'am, basically, first of all, I'll reform the economic sector. At that time, the Zimbabwean government was a dictatorship government. They were not showing any finances to the public as well as to the institution that they were taking money from. That is the World Bank. So, if I take loan from another institution, I will show them their my plan of action that will help my economy to increase. Also, I will promote more nationalism in the country. I will pursue them to make the goods in their own country, which will help increase the money supply in the economy.
Okay. Thank you, Manik. Thank you so much. It was nice presentation. You explained the situation of Zimbabwe very nicely. Can we have the next presentation, please? Okay, the last one, financial crisis of 2008. Yes.
Good afternoon, one and all present over here. Good morning, ma'am. Good afternoon, ma'am. So myself, Harshul Agarwal, and my topic for today's presentation is Financial Crisis 2008. Next slide, please. The global financial crisis of 2008 is widely referred to as the Great Recession. It began with the housing market bubble created by an overwhelming load of mortgage-backed securities that bundle high-risk loans. There are many efforts to revive the economy were made through the American Recovery and Investment Act of 2009. Can you please change the slide? The 2008 financial crisis was the worst economic disaster since Great Depression of 1929. It occurred despite the efforts of Federal Reserve and the US Department of Treasury. The crisis led to the Great Recession, where housing prices dropped more than the price plunge during the Great Depression. 2 years after the recession ended, unemployment was still above 9%. That doesn't count the discouraged workers who have given up looking for a job. Change the slide, please. So we talk about now Lehman Brothers. It is the nation's fourth largest investment bank, which filed in bankruptcy, which is the main turning point in the crisis. After galloping to the rescue of other major financial institutions, the federal government drew the line with Lehman, allowing the firm to collapse. A decade later, a bankruptcy court is still wading through the wreckage. The bank trustee has sold thousands of its assets and paid out more than $130 billion to settle claims against it. But 365 former Lehman Brothers employees are still petitioning to recover millions in lost salaries and bonuses, potentially keeping the case in court for years to come. Next slide, please. So now we understand what is the actual outcome of the crisis. That bank hit hard by 2001 recession welcomed the new derivative product. In 2001, Federal Reserve Chairman Alan Greenspan lowered the Fed funds rate to 1.75%. Many homeowners who couldn't afford conventional mortgages were delighted to approve for these interest-only loans. As a result, percentage of subprime mortgage more than doubled from 6 to almost 14% of all mortgages between 2001 and 2007. The creation of mortgage-backed securities and a secondary market helped end the 2001 recession. Many of those with adjustable rate loans didn't realize the rates would reset in 3 to 5 years. In 2004, the Fed started raising rates, but at the end of the year, the Fed fund rates was 2.25%. By the end of 2005, it was 4.25%. These rates rose much faster than the past Fed funds rates. Please change the slide. So now we talk about the factual data of the Great Recession. Nearly accurately $144.5 billion moved from money market to treasury bonds. Secondly, $439.6 billion Treasury Department is spent. By 2010, bank paid almost 442.6 billion. Employment was still above 9% in 2010, and last $182 billion federal bailout for AIG. US Treasury later sold the shares for 22.7 billion in profit. Please change the slide. Now we talk about the causes of 2008 global financial crisis. The number first cause is caused by deregulation in the financial industry. Second one, permitted banks to engage in hedge fund trading. The third one reason, the main reason is bank demanded more mortgages. Fourth, created interest-only loans affordable to subprime borrowers. Please change the slide. Now we discuss about the short-term effect of the crisis. The crisis was the worst US economic disaster since the Great Depression. In United States, the stock market plummeted, wiping out nearly $8 trillion in value between late 2007 and 2009. Unemployment climbed, peaking at 10% in October 2009. Americans lost $9.8 trillion in wealth as their home values plummeted and their retirement accounts vaporized. In all, the Great Recession led to a loss of more than $2 trillion in global economic growth, or a drop of nearly 4% between the pre-recession peak in the second quarter of 2008 and a low hit in the first quarter of 2009. It is according to the Moody's Analytics reports, which I have mentioned in my presentation. Please change the slide. Now we discuss about the long-term effect of the crisis. The US economy has largely recovered. In late August, the US stock market set a record for largest running upswing in history, replenishing the retirement accounts of workers who stayed invested through bouts of volatility. Still, the recovery has not buoyed all consumers equally. Many workers have struggled to land jobs that paid as well as the positions that had before the recession. The time spent of the work and other drops in productivity since the crisis had led to a loss of about $70,000 in lifetime income of every American, according to the estimate of Federal Reserve Bank of San Francisco. 4.4 billion approx homeowners were underwater or on their mortgages, meaning they owed more than homes were worth, according to the real estate company Zillow. Please change the slide. Now we discuss the aftermath of the global financial crisis 2008. The first and foremost point is the housing market was deeply impacted by the crisis. Eviction and foreclosures began within months. The stock market in response began to plummet, and major businesses worldwide began to fail. This, of course, resulted in widespread layoffs and extended periods of unemployment worldwide. Eventually, the United States responded to the crisis by passing the American Recovery and Reinvestment Act of 2009, which used an expansionary monetary policy, facilitated bank bailouts and mergers, and worked toward stimulating economic growth. The housing prices saw a steep fall of more than 31.8%, though the US economy came out the recession after 2 years, the impact was still prevalent. We also saw that GDP in India fell from 9.9 to 7.8% in 2008. Approximately $12 billion worth of investors withdrew from the stock markets, and there a huge fail was witnessed. Also, the trade and fiscal deficit were hurt badly, but then the Indian government was prompt in answering the crisis. Next slide, please. So these are the main causes or main bottom line which results in the crisis. First, we have discussed already in the presentation. We have discussed in the second one also. The third one is since home loan was intimately tied to hedge funds, derivatives, and credit default swaps, the resounding crash in the housing industry drove to US financial industry to its knees as well. With its global reach, the US banking industry almost pushed most of the world financial system to near collapse as well. The 2008 crisis has similarities to 1929 stock market crash. Both involves reckless speculation, loose credit, and too much debt in the asset market, namely the housing market in 2008 and the stock market in 1929. So this concludes my presentation. Thank you all. Ma'am, you are not audible actually.
Sorry. So thank you, Harshal. It was a nice presentation again given by you. You tried to cover many points. So after, I'm not going to ask you any question, but do you remember there was an act that was passed to prevent any such type of crisis in future in US? Do you remember the name of that act or that particular reform?
Ma'am, I recall one policy lessons from the Great Recession.
Yeah.
The most important policy lesson of the Great Recession related to the monetary policy. I think when the central bank is targeting inflation.
Okay.
Yes, ma'am.
I'll give you an answer for this. Actually,
Okay.
what happened after this crisis? See, there are different type of crisis. This was basically a subprime mortgage-based crisis, and some also refer to as a bubble burst crisis. Okay, so there was a bubble that was created just by increase in the price of an asset, specifically the housing sector we are talking about. So this type of event should not take place in future. There was a act reform that came, and an act was passed in US, that was Dodd-Frank Wall Street Reform Act. It was passed to prevent any such recessions in future. So Thank you so much. So all the students, you all tried to do justice to the topic that are assigned. So I'll just be concluding by simply saying that, see, the world economy has witnessed different type of financial crisis, and these financial crises are typically multi-dimensional event, and it's very hard to characterize it using any single indicator. And as the world's market is getting highly integrated, so the spillover could be seen across many economies, and it has become very difficult to insulate any economy from the effect of such financial crisis. And moreover, a financial crisis is often associated with one or more phenomena, such as substantial change in credit volume and asset price, severe disruption in financial, like what you can say, intermediation and supply of external financing, and large scale balance sheet problem of a household, of a financial intermediary, or what you can call as even a government, a country, and a large scale government support in the form of liquidity support and recapitalization. So the crisis has possessed new challenges to fiscal and monetary policies in all the countries, and the prevention implies basically the financial regulations, the reforms of the global financial system to become more resilient, and the changes that can change the role of the central governments of the country. So I hope this is all for today's session. So we will be closing this session, and we'll go for another session. Simon, if you want to add anything.
Just a big thank you for all the presentations and the really interesting details that were expressed and put across. A bit conscious of the time, so I won't say much because of the next session that's coming very soon.
Yeah. So Anupama ma'am, shall we close the session now? She's on hold. She may be in the class, so MC team can close the session now. Thank you, Simon. It was nice interacting with you.
Yes, thank you very much. Pleasure's all mine.
Yeah.
I'll see you again soon.
Yes, we'll be meeting in the next session very soon, right? Thank you, everyone. Bye-bye. Take care. Yeah.
Bye.
Bye. Yes, Riya, shall we close the session?
Good evening, ma'am. Thank you so much for the informative session, ma'am.
Yeah. I hope it had helped you out in getting the flavor that how much we have gone through in the past. I think
Absolutely, ma'am. Absolutely, ma'am.
Sure, ma'am. Ma'am, actually, I think Anupama ma'am will close the session.
Okay.
I think she is on hold. I'll inform the ma'am.
She's right now in the class. She's in my class only.
She's in the class. She's in the class, and her class is till 4 o'clock, and she'll come for the this valedictory, and valedictory is going to take place here only. I think so.
Yes, ma'am.
Yes, ma'am.
Yes, ma'am.
Okay. So what's next for us?
Ma'am, the closing ceremony.
Break for 10 minutes and then closing ceremony.
Okay. So for me, shall I leave it temporarily so that I can go move to my
sure,
cabin?
ma'am.
Yeah. Okay. Thank you, everyone. It was nice try from your side, and definitely you all will be learning a lot of things in future. So thank you, everyone. Bye-bye.
Bye, ma'am.
Thank you, ma'am.
Okay.